Welcome back to the Quarterly Call. All content is for informational purposes and is not investment advice. Please consult with an investment professional.
So today we're digging into a really unique story, almost a paradox.
Hmm.
It's centered on C.H. Robinson Worldwide, or CHRW, the massive global logistics provider.
Right.
We've been looking at their commentary from a few different places. The Deutsche Bank conference back in August, their Q3 investor updates, and then most recently the UBS conference in December of 2025.
And what just jumps out at you right away is this core conflict, this paradox you mentioned.
Yes,
You've got
I
this
guess-
huge, famously cyclical company, and it's operating in what is, it's a historically brutal environment.
Right, a freight
A
recession.
multi-year freight recession, and yet somehow they're achieving what they keep calling higher highs and higher lows.
And expanding margin
And
usage.
expanding their margins,
Yeah.
all while consistently, quarter after quarter, just outpacing the market. And it's not a one-off thing, is it? We're talking about, 7 consecutive quarters of this outperformance?
7. So
Mhm.
when the entire mood in freight is just, doom and gloom, they seem to be thriving. It feels totally counterintuitive.
It really does. It makes you ask the obvious question.
How?
How? Because the conventional wisdom, right, is that in logistics, you are basically a hostage to the macro cycle.
You ride the wave up, and you get crushed by the wave on the way down.
But the narrative they're putting out there very clearly across all these discussions is that they've changed something fundamental, something structural.
They're not just waiting for the tide to come in anymore.
Yeah.
It feels like they're, building a totally different kind of boat.
Okay, so let's unpack that, because
Yeah.
this isn't just about surviving a downturn. This is a story about a company trying to fundamentally change the economics of their business.
Exactly. And our mission today is to really get into that internal mechanism.
That's secret sauce.
Precisely. They call it lean AI. It's this fusion of a really disciplined, lean operating model with this aggressive and proprietary AI deployment that they've built in-house.
So this whole discussion is about figuring out how that combination, this lean AI, creates a real competitive advantage that lets them defy gravity in this market.
It's the only explanation.
Okay, so before we get to the solution, let's start with the problem. The gravity, as you called it.
Yeah.
We need to set the stage and really understand just how bad this macro environment has been.
It has been just relentlessly tough. Recession almost feels too gentle a word for it at this point.
Right.
We're talking about a freight recession that's been dragging on for more than 3 years now. This isn't some quick dip. It's a long structural stagnation.
And there's hard data on this, isn't there? The Cass Freight Index is always the big one everyone watches.
That's the bellwether. And in the third quarter of 2025, it marked its 12th consecutive quarter of year-over-year declines.
12.
But it's the context that's even more severe. That Q3 reading. It was the lowest they've recorded since the absolute depths of the 2009 financial crisis.
Goodness. So not since 2009.
It tells you that the sheer volume of goods moving around the country has been pushed down to levels we haven't seen in 15 years.
Mm-hmm.
We are at a very, very low baseline for commercial activity.
12 straight quarters is just staggering. So what's driving this? What specific parts of the economy are just not pulling their weight in terms of freight demand?
Well, the company sort of breaks it down into the key drivers, and honestly, none of them look good.
Okay.
They point to 3 big sectors: housing, manufacturing and industrial, and then retail.
Housing, I've got to imagine, is the worst of the bunch because of interest rates.
Oh, absolutely. Housing generates so much downstream freight, appliances, lumber, furniture, all of it. And they describe that trend as pretty starkly down and to the right.
Yeah, that's not a good chart.
No. High rates have just choked off new construction and existing home sales, which cuts off a massive source of high-margin freight.
What about manufacturing? You hear all this talk about reshoring. Is that providing any kind of lift to offset the housing weakness?
Not in a meaningful way, it seems. They describe manufacturing and industrial activity as muted or flat.
So stable but low.
Stably low, exactly. We're just not seeing that robust capital spending or production boom that you'd need to really pull the market out of this slump.
And retail, that's usually the one bright spot, especially heading into the holidays. What's the read there?
The retail data, and they admit this, is not clean.
What does that mean?
The big issue is all the complexity around trade policy and tariffs. They saw customers doing these big inventory pull-aheads earlier in the year because they were anticipating new tariffs.
Ah, so they were buying ahead of the tax, essentially.
Exactly. So the recent retail volumes might look a little better month over month, but it's not a signal of healthy consumer demand. It's inventory moving ahead of policy, not ahead of actual demand.
Okay, so demand is just historically weak across the board. What about the other side of the equation, the supply side? Are we seeing enough trucks leave the market to bring things back into balance?
We are, but it's a slow, painful grind. The clearest sign of progress is just attrition.
Companies going out of business.
Smaller carriers, less disciplined brokers, they just can't make it work in a low-volume, low-rate world, so they're exiting the market.
Hmm.
And this steady exit of capacity, combined with slightly better load-to-truck ratios, suggests the market is slowly, maybe crawling, towards some kind of equilibrium.
But not anytime soon.
No. The general forecast seems to be maybe 2026, probably the back half of the year. But for now, CHRW is operating as if this lower-for-longer environment is the new reality.
And speaking of complex realities, the picture for their global forwarding business is even messier, right? With all the international volatility and tariffs.
It's a total minefield of policy risk.
Yeah.
There's just no clarity, so customers can't plan 6 months out, and we saw the real-time effects of this.
Like what?
Well, in the second quarter, there was that effective embargo on some Chinese imports into the U.S. in April. That one policy decision caused volumes on that lane to drop over 60% in certain weeks.
60%. That's chaos for a supply chain manager.
It is. And that chaos, that need for flexibility, is where they say they actually benefit.
How do they turn that chaos into a revenue stream?
They become the expert in the room.
Yeah.
When there's that much uncertainty, customers need a partner who can handle really complex moves and, just as important, who understands the regulations.
Right.
They specifically noted that this volatility creates a huge spike in demand for their customs and duty services.
Ah, okay.
So their customs revenue spikes because customers are relying on them to navigate all these constantly changing rules. The management view is that tariffs are basically here to stay, so this complexity and the service revenue that comes with it is a durable advantage for them.
That makes perfect sense. They're basically monetizing the friction that government policy creates.
Mm.
And they talked about how their customers are reacting, right? They group them into 3 different strategic buckets.
Right, which is a really helpful way to think about how big companies manage this kind of risk. The first bucket is the really well-capitalized companies. They do what's called forward buying.
So they use their strong balance sheets to just buy inventory early.
Exactly. They stockpile goods to get ahead of tariff increases. It's like buying tomorrow's inventory at today's tax rate.
You'd need deep pockets for that. What's the second strategy?
The second group gets really focused on critical items. They triage their supply chains.
So they prioritize things like parts for a new product launch or high-demand stuff like back-to-school items.
Right. For those critical things, they'll just absorb the cost or pass it on to the consumer. For everything else, the non-critical stuff, they might just delay it or cut production.
And the last group is trying to solve the problem at its root.
That's the shifting sourcing bucket. These are the customers who are actively re-architecting their supply chains.
Moving production from China to Vietnam or Mexico, that kind of thing.
Exactly. And in all 3 of those scenarios, forward buying, prioritizing, or shifting, CHRW becomes the operational partner they need to actually execute those complex moves.
Okay, so let's tie this all back to the numbers. Despite this horrible freight market, the Cass index collapsing, all this global chaos, how do they actually perform in their biggest segment, North American surface transportation?
The comparison is really something. So remember, the overall market, based on that Cass index, was down a shocking 7.2% year over year in Q3.
Down 7.2%, okay.
Yet their North American business, what they call NAST, their combined truckload and LTL volume actually grew by about 3% in that same period.
Wait, so a 10-point swing, a 10 percentage point delta against the market?
Exactly. It's a massive grab for market share. And it's not new. It's now been 10 straight quarters that they've outgrown the market's decline.
Wow.
So their whole thesis is being proven out.
Yeah.
You don't wait for the market to recover. You focus on what you can control, and you just execute better than everyone else.
I have to ask the skeptical question, though. Growing 3% when the market is down 7%? Are they just buying that volume? Are they slashing their prices just to keep trucks moving and bleed out the competition?
And that is the perfect question, because it leads us right into the next part of this story.
Okay.
If they were just buying volume, their gross margins would be getting crushed. But they're not. They're growing volume and expanding their margins at the same time. And that's something that's basically impossible to do without this lean AI machine they've built.
Okay, so that's the perfect transition. Let's get into that core transformation. If they're winning, no matter what the cycle is doing, it has to be because of this structural difference they talk about.
Right.
What actually makes up this competitive moat?
They boil it down to the combination of three things. First is the disciplined cultural change of your lean operating model.
Right.
Second is their proprietary industry-leading technology. That's the AI part. And third is their people, their deep bench of logistics experts.
And it's the integration of all three that matters.
It's the integration. That's what they stress. Anyone can license some software or hire smart people. But weaving all three into one self-improving system, that's the real moat.
So let's start with the foundation then, the lean operating model. They call this the pulse of the company. It's the non-tech piece that I think gets overlooked.
It's absolutely the cultural prerequisite. You can't just drop AI into a broken process. Lean is all about continuous improvement, a sense of urgency, and failing fast.
Which has to be hard in logistics since it's historically so fragmented and manual.
So hard. This is the heavy lifting, changing how 16,000 people think about their jobs every single day.
So how do they make that real? It can't just be a motivational poster.
No, they use a classic and very demanding lean technique called Gemba walks.
Kimba.
It's Japanese for the actual place. It means the senior leaders have to literally go to the place where the work happens. They sit at the desks with the employees and watch the real, unfiltered workflow.
So they can see the friction firsthand.
Exactly. They see all the waste and the unnecessary steps in that whole quote-to-cash cycle. And that hands-on commitment is what identifies the exact problems that the AI then needs to go solve.
And that process, that commitment, drives a baseline level of improvement every year.
A baseline of single-digit productivity improvement every single year. It's the engine that just keeps finding new things to optimize.
So where are they on that journey in terms of rolling this out across the whole company?
They use a baseball analogy, which I think is helpful. They say they're only in the third inning of deploying this across the entire enterprise.
The third inning, so there's a long way to go.
A very long way. They look at companies like Danaher, who've been doing this for decades, and see them as being in the fifth or sixth inning. The implication is huge. It means they see decades of potential optimization still ahead of them.
A really long runway for more efficiency then.
Independent of what the market is doing.
Okay, now let's layer in the tech, the AI and lean AI. What's the guiding principle for how they invest in artificial intelligence?
It's a very strict rule. No hobby AI.
No hobby AI. I like that.
It means AI is not a buzzword for a press release. Every single dollar they spend on it has to have an ironclad return that shows up clearly in the financial results.
So revenue growth, margin expansion, cost reduction.
If the AI doesn't drive a measurable improvement on the P&L, they don't build it, period.
And they're building this themselves, right? Over 450 in-house engineers. Why is that in-house part so important instead of just buying something off the shelf?
It's all about domain expertise and speed. A lot of those engineers grew up in the freight business. They understand the difference between truckload and LTL. They get the complexities of global customs.
So you don't have to spend months explaining the problem to an outside vendor.
Exactly. When it's your own team, they can experiment, iterate, and deploy a new AI agent in just days or weeks. That speed means by the time their competitors are just figuring out how to implement generative AI, CHRW is already scaling up agentic AI.
And of course, the fuel for any AI is data. How big is their data advantage?
They say it's the largest data set in the industry. They handle 37 million shipments a year, which is, enormous. But what they said was even more valuable.
What's that?
It's the data on the loads they don't win.
Oh, that's interesting. So the failures are as important as the successes.
More important in some ways. That lost load data gives them incredible pricing intelligence. It tells them their win rate on a specific lane when a competitor is undercutting them or when a customer is super price sensitive.
And that feeds back into their AI models.
It makes their pricing and costing models so much more sophisticated than anything you could build just using public market data.
That feels like a moat that's almost impossible for a competitor to cross. You can't buy someone else's internal win-loss data.
It's unique, it's proprietary, and it compounds on itself every day.
So let's quantify this. What's the output? When you combine the lean culture with this data-rich AI, what kind of productivity gains are they actually seeing?
The numbers they're pretty stunning. Since the end of 2022, so in less than 2 years, this transformation has delivered a more than 40% increase in shipments per person per day
40%.
across their entire North American business. It's a massive, massive productivity jump.
40% is just an astronomical number. It kind of shows you how manual that process must have been before. But I have to ask, is there a risk here? When you push for that much efficiency, do you burn out your people? Or, worse, does the quality of your service start to suffer?
And that's the core tension, right?
Mm.
But they address that by being very specific about what the AI is automating.
Okay.
The goal isn't to make the human work 40% harder. It's to eliminate the waste, the mundane, repetitive, low-value stuff that the lean process identified.
Like data entry or scheduling calls.
Exactly. If an operator used to spend 60% of their day on that stuff, and now the AI handles it, they're freed up to spend that time on high-value strategic problem-solving for their most complex customers.
So they argue it actually improves service because the human experts can focus on things that actually require a human.
They automate the repeatable, not the relationship. That's the idea.
Which leads to the real long-term prize here, doesn't it? The ability to decouple headcount growth from volume growth. That's sort of the holy grail for operating leverage.
It is the absolute key to their future economics.
Mm-hmm.
Historically in this business, when volumes came roaring back in an upcycle, your costs came roaring back too because you had to hire thousands of people.
Right.
This new model just shatters that old cost structure. The processes are now human-like. So when the volume surge comes, they don't need to hire 1,000 people. Maybe they hire 50.
Because the process is now scalable and automated.
So the marginal cost of taking on more business is tiny. It's basically just the token cost for the AI to run. And that creates the potential for just massive, unprecedented operating leverage when the market turns.
So they've built a machine where in an upcycle, revenue can soar, but the costs associated with it stay mostly flat.
Exactly. They're in pole position, as they say. No matter what the market does next, their system is built to absorb that volume and just widen their margins.
Sure.
It completely flips the script on the old business model.
Okay, let's get more specific on the tech. Let's talk about the AI in action. The current wave is generative AI, and you mentioned NAST is in the third inning of that rollout.
And the customer quoting process is probably the best example of the ROI.
How so?
Historically, quote, requests come in all these messy, unstructured ways, right? An email, a voicemail, a human could only get to about 65% of them.
Which means 35% was just lost opportunity, lost revenue left on the table.
Completely. Now, with the Gen AI models, they respond to 100% of quote requests, 247. But it's the speed that's the real killer app. The average response time is now about 32 seconds.
32 seconds for a complex freight quote is incredible, and I have to assume the quality of the quote is better too.
It's exponentially better. A human under pressure might use a few data points to make a quick guess. The AI uses hundreds of data points, including all that lost load data we talked about, to create a super surgical price.
Which improves their win rate and their margin on each win.
Precisely.
They also gave a great example from the LTL space, less than truckload, which, for anyone who doesn't live in freight, is notoriously complicated.
Oh, it's a famous bottleneck.
Yeah.
LTL classification is this arcane process of figuring out freight class, density, handling rules. It's super manual and full of errors.
How long did that used to take?
A skilled operator took about 10 minutes per order.
Okay.
The new AI classification agent does the same task in 10 seconds.
10 seconds.
We're talking about a 98% reduction in the time it takes to do a critical step. And that speed means that today, 75% of all their LTL orders are fully automated.
That's the perfect definition of lean AI, just removing 9 minutes and 50 seconds of pure waste from a process.
And they're doing the same thing after the booking, too.
What do you mean?
They have an appointments agent. It handles all the scheduling pickups, deliveries, dock appointments for 40,000 different locations.
40,000.
Think about the number of phone calls and spreadsheets that used to require. Now it's just handled by an automated agent.
Okay, so that's the current wave. Generative AI doing this structured, repetitive work. But they're already moving on to the next wave, which they call agentic AI. How is that different?
This is the really big conceptual leap. If you think of Gen AI as a super efficient data clerk, agentic AI is more like an autonomous reasoning middle manager. It goes beyond just processing repetitive on-system data. It can handle complex reasoning and engage with messy, off-system, unstructured data.
Okay, give me an example.
So Gen AI can write a standard tracking email based on data that's already in the system. Agentic AI could, in theory, listen to a customer's frustrated voicemail, understand the context of the problem, search 3 different systems to find a solution, and then automatically generate a proactive, customized plan to fix it.
Without a human touching it.
It can use that unwritten tribal knowledge to make decisions in real time.
That sounds incredibly valuable, especially for a business as complex as global forwarding.
That's exactly where they see the breakthrough. They say tech deployment in global forwarding is only in the first inning. That business has so much complexity, different regulations, currencies, ocean-to-air transfers, that it's perfect for this kind of reasoning AI.
And they're deploying this now.
They are. It's part of something they call the always-on logistics planner. It's not one single program. It's a network of over 30 connected AI agents that work together.
To manage the global flow of goods.
Right. They automate the routine stuff, coordinate services, and importantly, they surface strategic insights that a human could never piece together that quickly.
Now, because this involves reasoning and autonomy, the development can't be a straight line. There has to be some risk here.
Oh, and they're very open about that. They say the innovation path is non-linear and iterative.
So 2 steps forward, 1 step back.
Exactly. You're giving reasoning power to a machine, so you need constant learning, feedback loops, and a human in the loop to supervise it. It's messy. But their whole build, learn, discover methodology is designed for exactly this kind of development.
So let's bring this back to the financials. All of this work, the lean culture, the 40% productivity gain, the shift to agentic AI, it all has to show up on the bottom line. And it seems like it is, especially in their margins.
The numbers really do back it up. That focus on disciplined pricing and dynamic costing, all powered by AI, has let them expand their gross margins even as the market shrinks.
So where are they now relative to their targets?
For the NAST business, they're at 38% gross margin, which they describe as being within spitting distance of their mid-cycle target of 40%. And global forwarding is also near its 30% target.
To be hitting those kinds of targets in the worst freight market in 15 years, that just shows how different their model is.
It does.
But here's what I found really interesting. They said they could probably exceed those targets, but they've made a conscious choice not to raise them. Why hold back?
This is that really smart concept of strategic optionality.
Okay.
If they went out and publicly committed to, say, a 42% margin target, they might be forced to turn away really strategic business that would make investors more money overall just because it came in at 41%.
So it's about flexibility. They're using their margin advantage as a weapon to take market share.
Exactly. They can choose to accept a slightly lower margin if it means securing a huge volume win that is accretive, meaning it drives higher total operating income, higher absolute profit dollars for shareholders.
So they're focused on growing the whole pie, not just their percentage of the slice.
And their AI pricing agents are making that trade-off calculation hundreds of times a day. It lets them be super aggressive in taking share from less efficient competitors who don't have that flexibility.
This confidence they have in their own execution, it really came through when they updated their 2026 financial targets, didn't it? They actually raised their guidance.
They raised it. Even though the macro outlook got worse between August and December, they raised their 2026 operating income target by about $50 million.
What's the new range?
It's now $965 million to $1.04 billion. But it's the assumption behind that number that's the real headline.
And what's that?
The bottom end of that range, which works out to about $6 of earnings per share, is based on an assumption of zero market volume growth.
Zero.
They are telling the market, we will hit $6 of EPS even if this freight recession continues all the way through 2026.
Wow. So that's a floor that is based entirely on their internal self-help story.
Purely on their productivity gains and the continued rollout of agentic AI. They're saying they don't need any help from the market, which takes a huge amount of cyclical risk out of the valuation.
It does. They're basically promising double-digit productivity growth in 2026, driven by that agentic AI scaling up.
They're confident they can now project these cost savings years in advance, which lets them override the uncertainty in the broader market.
So let's talk about that valuation. The management team clearly feels the market is mispricing the company.
They do. They fundamentally see themselves as a technology-generated company that just happens to operate in the logistics space.
But they're still trading like a plain old industrial, right?
Yeah.
Like a trucking company.
That's the disconnect they want the market to see. They believe they're trading at a discounted industrial multiple, somewhere in that 17 to 19 times earnings range.
And they think they should be higher.
They argue that a company generating these kinds of AI-driven returns, where growth is decoupled from headcount, that kind of company usually gets a much higher multiple, 25 times, maybe more. like a software platform.
They're making the case that their ROI on tech is real and measurable. It's not just a story.
It's not. It's that 40% productivity gain. It's that $6 EPS floor based on zero market growth. That's platform scalability, and it's unique among their industrial peers.
It's a compelling argument. The old multiple was based on the old variable cost model. If they've truly changed the model, the multiple should change too.
That's the bet. The old model was volume doubles, cost almost double. The new model is volume doubles, maybe costs go up 10%. That's a totally different financial animal.
What about growth from M&A? Mergers and acquisitions. They could, in theory, buy struggling competitors and just plug them into this lean AI engine.
And they said M&A will be part of the story, and they look at deals every week. But they also said the bar is extremely high.
Why so high?
Two big reasons. First is just the statistical reality. They pointed out that most M&A fails. Some studies say up to 84% of deals don't actually create long-term value.
So they don't want to get distracted by a big, risky deal.
Right. And the second reason goes back to their core strategy.
Which is?
The returns they're getting on their organic investments on this lean AI strategy are so high and so predictable that it's just really hard for an outside acquisition to compete for that capital.
Why buy something risky when you can get a guaranteed double-digit return internally?
Exactly. So their M&A focus will be much more on small, niche technology tuck-ins, not big blockbuster deals.
So if we just, synthesize this whole story, what we're really seeing is this profound shift. CHRW is moving from being a traditional cyclical broker to being essentially a scalable AI-driven tech platform.
That's a perfect way to put it. They've taken this manual, friction-heavy process and engineered it into an efficiency machine that can win in any environment.
And the power is in the compounding effect, not any single piece.
Exactly. It's not just the Gen AI or just the lean culture. It's the waves of productivity stacking on top of each other. The gains from lean, then the gains from Gen AI, and now this next big wave is coming from agentic AI.
And as you said, the biggest payoff from this new structured decoupling costs from volume, that hasn't even really hit yet.
Not at all. I mean, they're proving they can win in a terrible market, which is impressive. But the true power of this new model will be unleashed in the next upcycle.
Right.
When that volume surge finally comes, the operating leverage they've built with these human elite processes, it's going to deliver margin expansion that the 3PL industry has just never seen before.
It's just so fascinating that the story about AI and future-proofing a company comes back to something as simple as disciplined human observation, the Gemba walks.
It's process first, technology second, always. And, that really leads to a final thought for anyone listening, whatever your job is. This whole discussion shows that big productivity gains don't always come from some huge technological leap.
Right.
A lot of the time it comes from the simple rigor of continuous improvement, that commitment to just getting a little bit better every year. So the question for you to think about is, what daily, non-technical process in your own professional life could you look at with a lean mindset? Where can you go find the waste, eliminate the mundane tasks, and free yourself or your team up to focus on the stuff that really matters? Sometimes the biggest gains come from fixing the simplest friction points.
Thank you so much for tuning into the Quarterly Call. For more episodes, please remember to rate and follow our show. Until next time, stay curious and stay informed.